Hot Shots, it's your favorite not a financial advisor coming to you from not a financial advisor land. I've had some people telling me that these ETFs, these covered call ETFs with the real high dividend yields, are yield traps. I've been caught in yield traps before. Almost anybody that's ever looked at a dividend probably has been. You're always suckered into a high dividend, and then you just lose your principal because the company is eroding and they've just suckered in investors with the higher yield. But this is different. You have to understand how they're getting their income. They're getting their income through covered call writing, put selling, buying and selling calls, put spreads, credit spread, debit spreads, credit spreads. They're doing all kinds of strategies in these ETFs in order to generate these high yields. Now, I'm not going to tell you that you won't see any NAV erosion in them. I don't know that they've been around long enough for that to happen. And I do foresee another potential pitfall with them as more and more of them enter the market. But that's for another video. This particular video is just to say, are these YMAX ETFs, are the individual stock ETFs that are working on covered calls, is ULTY, is that a yield trap? Obviously it's paying a super high yield. And so if you buy into it and you wind up with some NAV erosion, then that's going to feel like a yield trap. But I don't think the reason that could happen is the same. The reason that could happen is just because they're losing more money than they're making when the market moves down and up, right? Like, so when it moves down, and now in order to get any kind of premium, they're going to have to sell calls closer to the strike price that the underlying stock is currently at, which is going to mean that stock can get called away from them at a price less than what they bought in for it at. So then they could lose money on that, and there could be some NAV erosion on that. Now, even if it doesn't get called away from them at that much lower price, they're not going to capture as much of the increase on the stock price as it goes up because they're selling covered calls, and so it could get called away and then they have to rebuy it and sell another covered call or a put or whatever. They have to, maybe they're doing some wheel strategy in there. So you can wind up with some NAV erosion, but it's not going to be for the same reason that a yield trap stock does. A yield trap stock is trying to bring in investors with this high dividend yield, but their company is failing. And so they're spending all of their free cash flow on these dividends, or they used to have a high dividend and they've got less free cash flow now, but they're keeping up that high dividend because they don't want to reduce it to, for posterity. They don't want to look bad. They don't want to scare investors away. So they keep paying that high dividend yield, but they're really using up all of their free cash flow to do it. Another possibility is that the stock was very expensive and they were paying a smaller percentage yield, but the company is failing, and so the stock value has dropped and they continue with that same, cents per share dividend, and so their yield looks like it's really high, but the reason that it's really high is because the stock price just keeps going down. So those would be how you wind up in my understanding, that would be how you would wind up in some sort of a yield trap stock. But these are a little bit different because they're actually generating income from the options. So it's not exactly an apples to apples comparison when you're looking at a high yielding stock versus a high yielding covered call ETF. It's more along the lines of if you went and bought a stock and then you started selling covered calls on it. It's just that you're having somebody else manage that activity and manage that portfolio. Hopefully somebody that's more experienced and more skilled than you, but definitely somebody with more assets under management. And so they're going to be able to make bigger moves, and they're going to be able to make moves across more stocks, unless you buy a singular covered call ETF like MSTY, or one that's doing it on Hood or something like that. So there is a reason for the high income. I know there's a lot of people that don't know exactly what these funds are doing, and they look at them and they go, well, how are they paying these huge dividends? That's unsustainable. And it may be unsustainable, for the simple fact that they're going to have losers sometimes, and then that NAV is you're going to have to reinvest those dividends to get the NAV back up, get your original investment back. But you have to understand there is an actual reason why the yields are that high, and it's because it's a whole different activity than just buying and holding the stock. And, it is possible for you to do this on your own. It's just very time intensive. And so if you can pay somebody, 0.65 or 0.95% in management fees for the fund, and they do it for you, to me, that's preferable. And so they've got more time to sit there and look at it. They've got people around them that are going to tell them what's going on with the markets at certain times, and when the volatility is up on a stock, so that then they can grab bigger call premiums. And so I'm invested in several of them. I'm going to be going over what my investments are in those, and I don't know if it's going to be a positive outcome or not. I don't know. I have Round Hill Trust RDTE. I'm basically breaking even on that one. I had it for several months, and we went through the downturn in the market earlier in the year, and the price on that one has not rebounded completely. But I was reinvesting the dividends, and so I'm about breaking even on it, which means that from here, assuming we don't have another downturn, which we could, but assuming we don't have another big downturn and the NAV stays relatively steady or goes up, I should be getting a pretty good yield off of that one. And it is across it's RDTE is for the Russell 2000 index, I believe. And so I am getting some exposure to the smaller cap stocks that way. And it's across a whole index instead of focused on one individual stock, which does diversify the risk some. But the managers of these funds make a huge difference too. And that's one of the reasons why I'm spreading it across multiple funds. I'm not just taking all my money and putting it into one fund, because if that fund, shits the bed, then now you're ass out. But if you just have several of them, the other ones can make up for it. That's why everybody diversifies, right? When one goes down, one goes up, and hopefully that happens. So hopefully it's going to be, even if I don't get, the 15% on some of the funds, or 70 or 80% on other funds that I have, hopefully it still winds up higher than what I would have had if I were just in SCHD, which I do have some SCHD too. So I don't think that's a bad investment for myself. I can't tell you what to do, but I don't think that's a bad investment for myself. However, it's a lot slower. Obviously I want to speed things up if I can. Who doesn't want more money faster, right?